Hey everyone, and welcome back to the show. I'm so excited to introduce our amazing guest today, Travis Watts from Ashcroft Capital. Travis, thanks so much for being here.
Thank you so much for the invite. I'm thrilled to be here.
Awesome. So, everyone, Travis Watts is a full time passive investor. He has been investing in real estate since 2009 in multifamily, single family, and vacation rentals. Travis is also the Director of Investor Relations at Ashcroft Capital. He dedicates his time to educating others who are looking to be more hands off in real estate. Well, that's what we do here too, Travis. So thanks so much for being here. Why don't you start us off with telling us how you got into the real estate space from what you were doing in your W 2?
Sure. Yeah, happy to start there. And thanks again. We were talking before for the show, everybody, just what a small world it is. We've been to a lot of the same conferences. We know a lot of the same people. So this is beautiful. Seems like a really good fit and happy to share with your audience. So, but just in a bullet point format, basically what happened was I was working a W-2 job, active income, 98 hours per week consistently. That's 14-hour days, 7 days a week, and it was in the oil industry. And so I was wanting to get into real estate because I had some excess income, right? I had to put that somewhere, and I was living very frugally. This is kind of a post-college story. And so I was saving a huge portion of my pay, and with the intent of one day building financial freedom, financial independence. Didn't really know how I was going to do that or how long it was going to take. I really wasn't doing a lot of self-education early on. We're talking about, by the way, for time reference, 2009 is when I started in real estate. And so didn't know what I didn't know, didn't have mentors per se, didn't have podcasts like this. I'm sure there were. I just was tuned out at the time, and a little bit naive and a little bit, I don't know how to really say that, but my ego, I guess, got in the way. I just thought, I can do real estate. I can figure this stuff out myself. I don't need any help. I'll just start flipping houses and whatever. And so I did a multitude of active strategies, fix and flips, vacation rentals, buy and holds, this kind of stuff. And I kept, transitioning all the time to where I was essentially starting fresh and new and naive on everything I did. And it got to be a lot of work. As you can imagine, if you're working 98 hours a week, it's pretty tough to dedicate enough time to your real estate to be successful, right? You're competing against people doing this full time where they've got 20, 30 years of expertise, connections, brokers, realtors, they got the whole network. And who am I? Right? And so that was a process of self-discovery. It took about 6 years of doing that before I burned out. And I just said, naively, I thought I want 100 single family homes and then I'll pull the plug and call it retirement. But not even 20% of the way there, I'm realizing this is really difficult. And lenders are starting to say, hey, look, you got a lot of debt on your books. We don't want to give you another loan. And I'm hitting all these hurdles and these roadblocks. I thought, okay, I got to get educated, right? I got to figure this out. How are people doing multifamily investing and apartment investing and stuff like that? And so what happened was I was fortunate to get a couple mentors who were full-time LPs, full-time limited partners like I am today. Never heard of that concept, didn't know what that meant. It was all jargon, but they opened up to me as a mentor in just little short spurts over a lunch or just a 15-minute call or whatever. And they shared with me what they were doing as limited partners in apartment syndications or real estate private placements. And it just blew my mind that I could actually be an investor in real estate. I could still get the tax benefits. I could still get the cash flow. I could still participate in the equity upside, but I don't have to be managing the tenants. I don't have to be driving, on the weekends out looking for properties and doing all the underwriting and due diligence and building teams. I could just be partnering with people already doing that stuff, people who are experts in the space, And for me, that was just what I needed at that time in my life. I needed to get out of this. I wouldn't call it a corporate rat race, but it was certainly the rat race. I was 100% exchanging my time for dollars. And I just wanted more, quality of life, basically. So that's kind of the story in the nutshell. So Yeah, to your point, I started in 2015 doing these passive investments in multifamily. Started investing with Joe Fairless over at Ashcroft Capital. Been investing with them about, I don't know, 5 years now. And just those types of models make a lot of sense to me. I'm passionate about sharing things that have worked for me with others to help them. And so that's what I do today in a role of director of investor relations and a full-time passive investor. So that's the story in short.
For sure. And did you transition out of your, single family and vacation rentals to be just purely a passive investor?
It took a little time, but yeah, I did. You know what I did? I sat down and I think it was with just like an Excel sheet, and I said, all right, I own, these various properties and various business models, and then the house that I live in and my brokerage and my cash accounts, all this stuff. I said, what if I sold everything? I went completely liquid. I paid the taxes and the realtor commissions and the whole deal. What would I be left with? So in other words, I was finally calculating my net worth and figuring out what could I otherwise be doing with my money? Then I said, okay, conservatively, what kind of cash flow could I be generating if I put that amount of cash to work in these apartment syndications? When I ran that math and those numbers, it inspired me even more because I realized, okay, I can finally leave the job that I hate doing. I can finally get out of this rat race and I can go pursue other work that I'm actually interested in, that I'm actually passionate about. For me, the oil industry was not very enticing. And I knew eventually one day I'd be laid off anyway. That's how it's a boom and bust kind of industry. So that's kind of how it went. So yeah, so I started that process. I had one single family home already selling, and I said, I'm going to experiment. I'm going to take 50,000, I think is what it was, and I'm going to put that in one deal, just a minimum investment, and I'm just going to test the waters. I'm going to wait 6 months. I'm going to make sure this is a real thing. And then, distributions came in, reporting came in. I thought, this is legit. This is exactly what I was hoping this would be. And so from there, I just ended up putting more properties up for sale as my leases would end or what have you. And yeah, I ended up over the course of about 18 months or so, I ended up selling all my single family homes and going 100% into cash flowing assets, mostly value add multifamily syndications, but some other asset classes as well.
For sure. So were you already at that when you decided to calculate your net worth and see what you could get? Were you at like a comfortable place, or did you have to make a plan for how much longer you were going to keep working?
Yeah, good question. So for me, again, I want to throw out a quick disclaimer. I'm not a financial planner, not a financial advisor, so please do seek licensed advice. But for me personally, to myself, I'll share this with your audience. I use the 8% rule. It was something I made up for myself, and that was the conservative cash flow that I was talking about. And I said, these deals I'm going to be going into, just for example purposes, they might be distributing 8% cash flow annually, but they might also have 8% equity upside potential. So I'm not going to bank or count on that equity upside potential because that's more of a guess, right? But I can bank on that 8% cash flow more reasonably because we have a long track record of looking at it. These are stabilized cash flowing assets that I'm going to be investing in. So I decided I'm going to live on 8%. And the rest is just whatever. It's an inflation hedge. It covers taxes. It covers dips in my portfolio, whatever. And so that's the model that I pursued. That may not work for everyone. That may not work if you're investing in stocks or other things. I mean, this is very particular in value add multifamily real estate. So to answer your question, so the 8% rule would suggest what? You have 625,000 invested at 8%, 50,000 a year. You have 1.25 million, 100,000 a year. So that's the numbers that I'm thinking of that kind of worked. And so when I was looking at that, I thought, I can afford to leave this job, this high income job. I'll still be active in other things in my life that generate income. And I'll combine the two, my cash flow with whatever I'm doing actively. And I'll basically end up, at the same result, that what I was making, except I'll have a 40-hour work week or less and not 100. And so that was the decision for me. And then as I've gone over the years, I just realized how many doctors, dentists, lawyers, attorneys, high income individuals, net worth individuals needing to park capital. It may not make sense for a doctor, for example, to go fix and flip a house on the weekends, right? And go back to the office. I mean, if you're making 200, 300 an hour, it may not be justifiable. So a lot of people, that invest in syndications are kind of in those types of roles.
For sure. So, Travis, how did you meet your original LP investors?
Yeah, the two mentors. So when I got serious about my education, this was a crazy year. 2015 was like an insane year. I was working overseas at the time. I had a schedule that was 35 days on, 35 days off. So I had literally half a year off. So I did a lot of self-study every minute I was home. I was reading books, I was listening to podcasts, I was going to real estate meetups. I was just putting in the time because I had the time and I knew this is it, man. I got to make a leap or I'm going to be stuck here. So I read 52 books that year. A book a week was my goal. I did that. I don't suggest anybody do that. It's too much information to retain in 1 year, and it prevented me from taking some action too that I could have otherwise done. But anyway, I met him through a real estate meetup group. It was a local group. There was like, oh God, I don't know, 100 people there. And these two older gentlemen, I think one in his 60s, one in his 70s, were there, and full-time LPs and had been for like 20 plus years. What happened was they sold a business a long time ago and they had enough money. All of a sudden, they never really anticipated having money in their lives, but they walked away with several $1,000,000 and they just became full-time investors basically. And they didn't only invest in value add multifamily syndications, but the bulk of their portfolio was that. And that's where I really discovered the power of private placements, cash flow, tax advantages, all these great things that we all love and know about real estate. And so, yeah, that was kind of the light bulb moment in 2015. That made more difference. Those two mentors in 2 or 3 conversations made more impact than 52 books that year. So I'm a big fan of having mentors.
Awesome. And what sort of suggestions would you make to folks who are, wanting to sort of meet mentors or people who could help them, guide them?
Yeah, well, there's a couple different ways to go about it, right? You have paid mentorships. That's always an option. You have coaching programs, things you can join, conferences you can go to and pay thousands of dollars. And then you have free mentors. But the thing about free mentors, you have to find a way to add value to somebody, right? We're all busy. We all got things going on. None of these folks have time to just be doing, hour-long phone calls all day, every day, all year long with people. So you have to sometimes, like, hey, I'll intern with you, or I'll work with you on something, or I'll help you do this or that, or, analyze deals or whatever, in exchange for mentorship. The other thing is, if you're going to do free mentorship, well, first of all, working for someone for free is a great way to do it. I mean, if they're open to it, you're not going to get like billionaires to probably, take you up on that offer, but like these types of guys that are my mentors would absolutely do that. And so the other thing about free mentorship is, don't ask for too much time. Be organized, be prepared, write down your questions, know what it is you're after and why you're asking your questions, what your goals are. Do a 15-minute call. Don't even bother about, can I take you out for lunch or coffee? A lot of people are too busy for that stuff, right? Just, hey, would you please give me 15 minutes on a call? I'm not selling anything. I'm just trying to learn myself. I think what you do is very interesting. I think it might be a path that could really be helpful to me. And I would just love 15 minutes of your time if you're willing to do that. That's it. Just a short and sweet like that. And I found more mentors that way than any other way, right? Because it's not a huge commitment to people. The worst case scenario, hang up the phone, So that's what I would suggest.
I think that's a really great tip because, I think a lot of times we're like, somehow there's this idea that, you need to go take people out to lunch. And that's like actually kind of big commitment for someone to take that kind of time out of their day for someone who they might not have met yet. So
it is. It certainly is. And I'm nobody big and famous and all this kind of stuff, but I quit doing that because, 30 minutes over there, an hour long conversation, 30 minutes back. I mean, what, a coffee? I mean, it's just not, it's not a good ROI on your time. So happy to give people a 15-minute call or a Zoom call. But yeah, I'm kind of, I don't even do that stuff. So just keep that in mind with, especially with your higher, net worth individuals and people like that.
Yeah, for sure. So, we've kind of talked about this, but let's see if we can give a little bit more color as to what it is that you love about real estate syndications and maybe what some things are to watch out for.
Sure. Yeah. Well, first of all, pros and cons. I'm not here to say this is the best thing and you've never heard of it and it's going to just blow you away and change your life. It's not right for everybody. It's right for me for the reasons that I've kind of covered. But let's talk about some cons to it real quick. So, private placements are private, meaning there's no public market. They're not a stock. Okay. If I go put 50,000 into a deal and I need that money a month later, I'm not getting it. I can't get my money back. So be prepared if you're going to do this about a 5 to 7 year time horizon is just, a general sense just to think about. Your money is tied up. Okay. It's used for down payments and to rehab on a project. There's no liquid account sitting there in most cases where you just get your money back. So that talking about REITs, real estate investment trusts that are publicly traded in the stock market, if you think you might need your money back sooner, that could possibly be a better play. Or if you just want to put like $5,000 to work and not 500,000 or whatever, there's smaller amounts you can go put into other asset types that might make more sense for you. That's the key to why you need to seek license advice and not me for that kind of thing. But why I love them is it's a way for people to invest in real estate with scalability. Okay. And what I mean by that is whether I have one syndication deal or I have 1,000, it's scalable because I'm not signing the dotted line for the loan. My credit score doesn't matter, and once I make the commitment to invest, I'm done. I'm not going to be managing the tenants or anything that's going on. I'm going to leave that to experienced teams. And then I'm just going to collect either a monthly or a quarterly distribution in most cases. And so you still get, similar, same, sometimes better tax advantages from this type of investing than you would in like a single family home. And an example of that would be something called cost segregation. It might make a lot of sense on a big property, like a 400 unit apartment building, to do a cost segregation study that can help accelerate the depreciation and the paper losses to the investors. Whereas on a single family home, the numbers might not work out. If you got to go pay $5,000 to get a survey done to save $500 in tax, that doesn't make sense. But, to go pay 30K to save, hundreds of thousands might make a lot of sense. So I like the passive approach to it. The reason we were talking before the show, the reason that my wife and I intend on being full-time LPs for the foreseeable future, if not forever, is because of our lifestyle. Again, that's a personal thing. We like to travel a lot. We move pretty frequently. And these are just things that we like to do or that occur in our life. And so I don't, we don't want to be tied down to one area for a long time commitment like I used to be. It was always that conversation of, hey, we could take off to Europe and go take this month-long trip. Nope, got a closing coming up, I got a tenant moving out. I got to, there's always excuses and reasons why we couldn't live the lifestyle that we were wanting to live. And so again, for us, great fit, not for everybody, but just kind of recognize those pros and cons.
For sure. Yeah. And would you say though, for if you mentioned LP to LP, you're not looking to become an operator like
Right.
some people in this space are.
Mm-hmm.
But would you recommend for someone who's trying to grow their wealth to have like another business and take those profits and put them into syndication? Or like how would you kind of, I don't know, what would you kind of say about how to grow wealth most effectively if you're trying to kind of supercharge it?
Yeah, I think, I was listening to Warren Buffett and his partner, Charlie Munger, at one of their Berkshire Hathaway meetings. And Warren was talking about when he was first starting out, not very first starting out, but kind of mid career in the stock market. He said, we had so many strategies that we could implement. he said some of these years we were making 30, 40, 50% returns on our money. But the reason was we were working with small amounts of capital relative to what they have today at Berkshire. So the lesson there. Yeah, so the reason that they were able to make larger returns back then is because they were working with smaller amounts of capital. Let's say, I don't know, 1 to 2 million versus 10 to 20 billion. That's a huge difference. So there's not a lot of strategies when you get as big as they are today, right? Where you have $80 million to go, or I'm sorry, $80 billion to go put to work. So they were able to do these various things. So the point being, actively, sometimes you can make a lot better return on investment. So to answer your question, if you have anywhere from $0 to $100,000 to work with, and you're wanting to grow that with the highest amount of potential, syndication investing may not be the best approach, but it depends on you, because I know folks who are putting their money into CDs at the bank and making 0.1%. Well, if that's your alternative, then maybe passive syndications are a great way to build your wealth. But in comparison to maybe doing fix and flips or vacation rentals and self-managing and all this, you might have a higher return on investment with smaller amounts of capital. But like I mentioned earlier, with the 8% rule, you just run the numbers. When you start getting, let's say, a million bucks a year at 8% invested, that's 80 grand a year. So this is where it starts to become a little more life-changing for a lot of people, is when you have $80,000 rolling in without you having to get out there and have a job and work. But again, like my nephews, I started them investing with a brokerage account in publicly traded REITs. Why? Well, because they had $100. I mean, that's just the right fit probably for them. And even though they only get, let's say, $1 a month in cash flow, it's the concept that we're building, right? And then you turn that $100 into 1,000, then into 10,000, then into 100,000, and hopefully one day they're $1 million plus invested in something that produces cash flow. And so really that's, the path to financial freedom, in my opinion, what I did personally is, at first I had an active income and I earned as much as I could doing my highest and best potential. That was working a lot of hours and doing active real estate. Number two, I lived on as little of that as possible for a period of time. It was about, call it 5 to 10 years for a lot of people. That can be very life-changing if you can have that frugality mindset. Number three is invest in something. You can't just save. Invest in something, whatever makes sense for you. For me, that was cash flowing real estate with equity upside potential. Number four is avoid bad debt, financed cars, credit card, debt, get rid of that stuff. Don't take it on. That's really it. I mean, it's simple, but not easy. But those were 4 steps to build from $0 up to financial independence. And so, hopefully any of your listeners taking notes, maybe one of those things, maybe all 4 can resonate or help someone out. But, as much as I'm a real estate guy and as much as I've made money in real estate, I'm not tied to a particular asset type for life. Things change, markets shift. Ask me in 20 years, maybe multifamily is not the thing I'm in. Maybe I'm in something else that cash flows, but it's always going to have a cash flow focus, because that is where financial freedom is built.
Awesome. Well, thank you so much, Travis, for reviewing some of those concepts. A lot of the things you said kind of click for me. I mean, I definitely had a period of frugality in my life. I definitely worked at a sort of high paying career for a while. I definitely house hacked and then I built a business and putting the profits from that business into passive investments. And yeah, it's a bit of a stair step, right? So you kind of got to know where you're at in your wealth building journey, where you want to go, what you're willing to do to get there. And I think you did a great job of summing that up. So thank you so much, Travis, for coming on. I really appreciate it and would love to have you back again sometime to talk about maybe a case study of a deal or something that you've worked on. But for now, why don't you give the listeners a way to get in contact with you and anything else you'd like to share.
Sure. Yeah. Well, feel free to connect on any social media outlet. I'm on Bigger Pockets, LinkedIn, Facebook, Instagram, at Passive Investor Tips. Or if you want to do a 15-minute call, I try to be a mentor for everybody who's willing to learn. And there's no sale or upsell to this, but that can be found at ashcroftcapital.com/Travis. And my calendar's right there. You can just book a 15-minute slot. Happy to go over anything we discussed here, any questions you have about just syndication investing, et cetera, and happy to be a resource.
Awesome. Well, that is an awesome opportunity, folks. I hope you take advantage of that 15-minute call with Travis. And thanks so much, Travis, for coming on. We'll see you next time.
Thank you. Thanks, everybody.